Two FTSE 100 blue chips. One trading well below its 50-day and 200-day moving averages, the other surging near multi-month highs. Both were shortlisted by UK retail investors this ISA season, as defensive plays in a stagflation environment. That framing is the first problem. The assumption that consumer staples and pharma move together as defensives is being stress-tested right now. The FTSE rotation underway is not lifting all defensives equally. Energy stocks are gaining. Traditional defensives are splitting, and Unilever and AstraZeneca are splitting in opposite directions at the same moment. That divergence is not noise. It reflects a structural difference in how each sector absorbs a stagflation shock. Unilever's Q4 earnings miss was not a rounding error. The company reported EPS of 75 cents against an estimate of $1.75, a $1 gap. Revenue came in at $11.87 billion. That figure sits against a consensus expectation near $31 billion. The scale of that miss shifted the analyst community almost immediately. Weiss Ratings moved to sell on March 31st. Jefferies issued an underperform. UBS reiterated sell. That is three distinct sell-side signals inside one quarter. DZ Bank and Argus moved to strong buy earlier, but those upgrades predate the full earnings picture. The post-earnings consensus settled at hold, with a target of $65.55, against a current open near $58.40. The structural pressure is not mysterious. Oil above $111 per barrel feeds directly into the input cost base for a company operating across personal care, home care, and foods. Packaging, logistics, raw agricultural inputs, all move with energy. Consumer staples companies cannot pass that cost through quickly without volume loss. That is the margin trap. What most coverage misses is the timing asymmetry. Unilever's pricing power is sticky on the way down. Consumers trade to private label faster than brands can respond with promotions. The recovery path requires either an energy pullback or a multi-quarter brand investment cycle. Neither is fast. The plant-based snacks segment is often cited as a growth offset. That market is growing at a 12.24% CAGR. But Unilever's exposure to that segment does not insulate its aggregate margin, when the legacy personal care and home care divisions are absorbing the full cost shock. The growth story is real. The sequencing problem, paying for costs now while growth pays out later, is the tension that the bull case tends to compress. The Morgan Stanley overweight at $60.10 and BNP Paribas neutral at $71 represent the spread of conviction right now. Morgan Stanley's target is close to where the stock is trading. That is not a strong upside call, it is a floor defense. BNP's $71 implies a recovery to somewhere near the 200-day average. That recovery is conditional on input costs stabilizing and brand investment beginning to show volume recovery, neither of which has a confirmed timeline. Here is the point, that most of the Unilever coverage is not foregrounding. The consensus is treating this as a cost cycle story. Input costs rise, margins compress, eventually they normalize. Standard cyclical logic. But Unilever's revenue miss was not a cost-side figure. Revenue is a demand-side number. A company can miss earnings because costs rose. That is recoverable when costs fall. But when revenue misses by the magnitude seen in Q4, against a consensus expectation set by analysts who cover the company closely, that signals something about volume, pricing mix, or geographic demand that is not purely cyclical. The question the data raises but does not answer is whether Unilever is losing shelf position in key categories, at a structural level, not just a cyclical one. That distinction matters enormously for the recovery path. A cost cycle story recovers when oil falls. A volume loss story requires brand reinvestment, distribution rebuilding, and time. The sell-side models are largely running the first scenario. The earnings data is more consistent with at least a partial second scenario. This is not a call that the company is broken. Unilever's brand portfolio across 190 countries and 3 major consumer segments is not dismantled in one quarter. But the FY 2026 EPS estimate of $3.27, which underpins most of the hold and overweight cases, requires a significant step up from the 75 cents reported in Q4. That trajectory is achievable only if volume recovers alongside any cost relief. AstraZeneca's situation is structurally different. And the difference is not simply that pharma is doing better than staples this quarter, it is that AstraZeneca's pipeline diversification creates a different relationship between macro pressure and earnings trajectory. JP Morgan maintains a buy rating with a $211.49 price target. The stock has surged 3% recently and is trading near highs. Simply Wall Street flagged strong price momentum, but noted a premium PE, explicitly raising valuation risk. That tension between momentum and valuation is the central question for AstraZeneca right now. The pipeline reads across oncology, rare disease, cardiovascular, and respiratory. The non-cystic fibrosis bronchiectasis market, a less covered segment, positions AstraZeneca among high-growth opportunity companies through 2034. That is a long runway in a category where competition is still forming. Separately, the company's involvement in the biopharmaceuticals CXO market, growing at a 7.04% CAGR to 2032, adds a services and partnership dimension that pure product valuations often undercount. The AI lung screening launch in India's Telangana state is smaller in immediate revenue terms, but meaningful for a different reason. It signals AstraZeneca's positioning in emerging market healthcare infrastructure, where volume growth is secular, not cyclical. That is, geographic diversification of a kind that insulates the company from UK and US pricing pressure in ways that a domestic consumer brand cannot replicate. The premium PE flag is legitimate. When a stock is near highs with strong momentum, the margin for execution error narrows. A pipeline delay, a pricing dispute with a national health system, or a broader equity de-rating in UK markets, any of these could compress the valuation quickly. The bull case depends on pipeline milestones continuing to land on schedule. That is always a conditional bet in pharma, regardless of how strong the trajectory looks from the outside. AstraZeneca being the most mentioned UK stock this week, 26 mentions, reflects genuine institutional attention, not just retail interest. That level of coverage at a near-high price level cuts both ways. It means informed capital is engaged. It also means the stock has already absorbed a significant amount of positive narrative. The next move depends on what the pipeline delivers, not what the coverage says. The FTSE rotation framing is important context but not the core story. Energy is gaining. Defensives are under pressure. Within that rotation, Unilever and AstraZeneca were both being considered as ISA season picks. The implication being that defensive blue chips are a natural home for UK retail capital in an uncertain macro environment. The problem with that framing is that stagflation does not treat all defensives equally. Consumer staples face direct margin compression from input costs, and cannot easily pass those costs through. Pharma faces pricing pressure from governments, but has geographic diversification and pipeline-driven growth that is structurally independent of commodity cycles. The ISA season narrative lumped these two together. The earnings and price data have since separated them. That separation is the signal worth tracking, not because one is obviously better than the other in all scenarios, but because the conditions required for each to recover or advance are entirely different. For Unilever, the recovery path runs through either an energy pullback or a demonstrated volume recovery in core categories, whichever comes first and at whatever magnitude. The FY 2026 EPS estimate is the checkpoint. If volume data begins to inflect in the next 2 quarters, the hold consensus has upside room. If it does not, the sell-side targets above $65 start to look disconnected from the operating trajectory. For AstraZeneca, the path forward is contingent on pipeline execution and valuation discipline. Near-high prices with a premium multiple mean that any positive surprise is already partially priced. The upside scenario requires milestone delivery across the respiratory and oncology pipelines, particularly in the less covered segments like non-CF bronchiectasis, where competitive pressure is lower. The downside scenario is a valuation compression triggered by a single pipeline setback or a broader UK equity de-rating, neither of which the current price appears to fully discount. These two stocks are not a pair trade, they are not mirror images. They are two FTSE blue chips absorbing the same macro environment, through fundamentally different operating structures. The divergence visible in price this week is not an anomaly. It is the market beginning to price that structural difference correctly.